What's good, everybody? Welcome back to the Billionaire 23 Financial Academy. We hope video 3 has found you well. In video 3 of our Forex 101 series, we further expanded on the nature of the Forex market in terms of trading styles, namely technical trading and fundamental trading. We outlined what each trading style entails. Feel free to go back to video 3 to catch up if you're new. If you're not, let's get started with video 4, Forex brokers and market orders. So what are Forex brokers? Forex brokers are institutions or companies which give retail traders access to the Forex markets. By retail traders, I mean normal people like you and I, because we have what we call institutional traders, professional traders, and bank traders. Retail traders are everyday traders, normal people. Sorry, let me just correct this. Retail traders are normal everyday traders. The reason is traditionally only banks and certain companies were allowed to trade on the Forex markets. By certain companies, I mean your hedge funds, insurance companies, companies of that nature. So what Forex brokers have allowed is they've given us, normal people, the opportunity to trade on the Forex market as well. And it's important to note that you cannot trade Forex without a broker. As far as I know, it's impossible. Maybe you can find a different way, but for 99% of us out there, you need a Forex broker to trade in the Forex markets. So you can think of a broker like a bank. The same way a bank is responsible for keeping your money safe until you need it, brokers are responsible for keeping your trading capital safe until you either want to trade or withdraw your hard-earned profits. Basically, if you fund your accounts with a broker, any broker, and you don't trade whatsoever, your balance will remain the same. The difference with the bank is they have interest rates, they charge your accounts, stuff of that nature. But with a broker, whatever amounts you put in, you will find as long as you do not trade. If you trade, you will either increase your balance or decrease it. And mainly there are two types of brokers. We have ECN brokers and SCP brokers. So ECN stands for Electronic Communications Network, and SCP stands for Straight Through Processing brokers. So ECN brokers here, they give you direct access to the market and here's the key, they have very low spreads. They have very low spreads compared to SCP brokers. And then SCP brokers also give you access to the market, but they have higher spreads. That's primarily the main difference between ECN and SCP brokers. Their spreads are higher. It's just a personal choice on which one you prefer. I personally like ECN brokers, but a lot of people prefer SCP. I'll outline why in the following slides. So ECN brokers take commission for giving you those low spreads and are typically not recommended if you're just starting out on your Forex journey. So the difference is when you open an account with an ECN broker, whenever you open a trade of whichever lot size, they take a small portion of your balance for giving you low spreads. SCP brokers have higher spreads, but then they don't take commission. So it's just a personal trading choice of which one you prefer. There's really not much between them. It's just the spread and the commission. You'll make the decision on which is best for you. So I'll give you an example of the spreads. So on my left, we have the ECN broker. It's key to note that when I took these two screenshots, it was at market close. But even then, you can see the difference is massive between the two. We have an ECN broker here. The spread is around 19, 12, 11, 23, 3, 13, 12, 11, 15, around that. When the market is normal, when the market has opened, it's usually around 2, 3, 6, 3, 2, 5, 6, around there. So the spread is around 6, 5. So it's particularly low. And then with an SCP broker, you can see the difference is massive. The spread is around 250 pips, 117, 180, 120, 199. Here, I advise that you never trade regardless of how you're feeling that day. 250. So that's basically the main difference between an ECN broker and an SCP broker. So, don't worry, this PDF will be provided this PDF will be provided on our Telegram group. So everything that I'm explaining here, I'll also explain on the Telegram group. So don't worry about that. So now we'll move on to market orders. So what are market orders? So market orders are actions taken by Forex traders to get into the Forex market, basically. So there are 4 types of market orders, namely market execution orders. We have buy stop and sell stop orders, stop loss orders, and limit orders. This is also a market order, it's just that I haven't highlighted it in a particular color. But I think let me do that now. We have market execution orders, buy stop and sell stop orders, stop loss orders, and limit orders. And it's also key to know that all market orders have their pros and cons, just like anything in life. Excuse the typo here, I will correct this before I send it to the Telegram group. So let's start with market execution orders. Market execution orders happen when you want to get into the market instantly, either with a sell trade or a buy trade. So it's instant, it happens in that moment. Buy and sell stop orders happen when you want to trade the market at a particular price point. They happen when you want to trade the market at a particular price point. But fear you may not be on your screen when that happens. So basically, it's a buy or sell trade that may happen in the future. It's something that you place on your MetaTrader 4 app, and then if price gets to that level, your trade will automatically be triggered. But I will show this to you on a live Forex chart once we're done here. And then we have a stop loss order. A stop loss order occurs when you want to limit the amounts of money you lose if the market goes against your trade. Because the market won't go in your favor every single time. That's why stop loss is vital to your success or failure in Forex as a whole. I'll also outline this in live charts. Then we have limit orders. Limit orders are similar to buy and sell stop orders. The only difference is limit orders are for reversal trades. Buy stops and sell stops are for continuation trades. I'll show you what this means on the charts. Then we have a lot size. Key information right here. So a lot size is the volume used in Forex trading that determines how much money you will potentially make or lose at any given time. I'll show this to you in the chart again. The lowest possible lot size is 0.01, with the highest generally being 100 lots. Maybe some brokers offer 1,000 lots, but the highest that I've seen in most is 100. So once you move from a lot size with a 0 on the left to a lot size with a 1 or above, we call that standard lots. Like here, there's a 0 on the left. Once this turns into a 1 or 2 or 3 or 4, it's called standard lots, which will be shown on the live charts. And then this will be outlined in our June videos. It's very key information, the most important information I could probably say. So we have risk management and pip calculations. I think this was done in video 2, if I'm not mistaken, but we'll outline it further, tying together what we just learned here with the lot size. So let's say we have a trading account balance of $500. We open trade using a lot size of 0.05, and we've decided we will only risk 150 pips per trade. If, let's say, the trade we opened hit our stop loss, we would have lost $7.5. Calculation for this is just down here. It's 0.05, which is the lot size, multiplied by the 150 pips, gives you $7.5. So the higher the lot size, the more money you can make or potentially lose. I will send the PDF on the Telegram group for those who want to note down the details. Group, and then here's the email address for any queries you may have regarding the paid classes. Now I think we can move on to the live charts. So now we're looking at a live chart. We're going to start with market orders. On your desktop, the market order section will be here, top left corner. You just have to like right click, and then you'll see the sell limit, there's trading depth of market, yada yada. We're just going to focus on trading for now. As you can see, there's sell limits, there's buy stop alerts. We're going to go to new order for now. New order. On the screen here, we have market execution. This is a way you just enter the market immediately. This is the live market. This is the current price. With market execution, you can just enter immediately. And then just below, if you choose pending order, you then have a variety to choose from. You have a buy limit, sell limit, buy stop, sell stop. So let's start with buy stop. Buy stop. Let me just use this. Okay. Currently, price is playing around in this area. It looks as if it's dropping. So basically, a buy stop is a continuation. So if you were starting from here, you would say, okay, price went up, it corrected, it's going up, it's correcting. I think it's gonna go further. So around this area is where I wanna buy. Maybe just making an example, around 1.47917 is where I wanna buy. So you here at price, you just type in the price level. Buy stop and then place. And then immediately you have an order waiting to be triggered. So like I said, buy stops are usually for continuations. So maybe you would have seen that, okay, price is moving up. It's correcting, moved up again. You may think this is a correction. And then you're saying, I want to buy price at this level because I assume it's going to continue going up. So if the market goes up and goes above this point, this buy stop automatically changes to a buy. Since it's buy stop with a lot size of 1, standard lots, once the market goes above this area or touches this area, your buy trade will automatically be triggered. So basically you've bought, but you're waiting for the market to get there in order for the buy trade to be in the market. That's what a buy stop is. It's a continuation order. The same with a sell stop. We will do that now. Or maybe someone is like, let me just delete this. Maybe someone is like, no, I think the market's going to continue going down. I see something like this happening, but I may be busy when that happens. So what you do is, you may say, once the market reaches this point or this point, whichever point you choose, like 1.47695, you can just go back here, trading, you go to new order, pending order. So now we sort of buy stop, we go to sell stop because you're assuming price is going to continue going down. Buy stop and sell stop orders are for continuations, and then limits are for reversals. I'll show you that. So let's just check the price. It's 47677. So you type that in. And then soon as you do that, you have a sell order right here waiting to be triggered. If price follows your prediction and does that, continues going down, you would automatically be in a sell trade. So this sell stop would then change to a normal sell with a lot size of 1 because it's a continuation. Now I don't know what's going to happen next. I haven't analyzed this currency pair. I was just making an example. This is only for educational purposes. And then let's go into limits. So what's the difference between a buy stop, sell stop, or buy limits, sell limits? Okay, limits are for reversals. So I think in the previous video, we kind of explained support and resistance. Yeah, I think we did. So let's say this is current resistance, 1.48195. And you assume price might do something like that. It might retest the resistance before dropping, but you may be busy when that happens. What you do is you place a sell limit because we think price is going to reverse. So you just do the opposite. You go to sell limits. Here's the price level. It's 1.48195. Then you have your sell limits at that level. Just trying to see if the can't remove. Okay, let me just do this. I want to get the line removed. Then we can just drop this back down to our resistance points. So it's possible that price might come here, and then you might be working or you might be busy with something. So you might place a sell limit at this price, then price might go up, touch it, and then drop. Price might continue dropping to the next support level, which maybe here, this price 1.46716. And you might be busy, you might want to buy here, but you don't get the time. You do the same thing, go to trading, you order, market execution, trading order, buy limits at 1.46716. Yes. And then we just move this out of the way. And then just like that, you have your sell limits, you have your buy limits. If price drops all the way here and then they trigger your order and go up, you'll be in profits. If price goes all the way here, they trigger your sell trade and price goes down, you'll be in profits. So now what happens if something like this happens? Let me just change time frame. What if price decides to just break through your sell limit? It doesn't go down, it just continues going up. That's where a stop loss comes in. Stop loss basically limits the amount of money you lose in a particular trade. So let me show that to you. Since we're selling and we don't want price to go further up from a certain point, let's just pick this level 48350. We're gonna right click here. We want to modify it. We want to go here to stop loss. We want to type in 48350, and then just like that, your stop loss is in place. Also, if you drag this, it kind of shows you exactly how much you're going to lose. Like here on my left side, or the left side of the screen, you have, I think, a loss of 7,000 rands or minus 647 pips. if I were to move the trade like that, currently I'd be losing about, I think, 4,000 in this example. But yeah, that's basically how a stop loss operates. If price goes all the way here, they trigger your trade, but then they continue going up, your loss would have been limited compared to maybe if you did not use a stop loss and then you just lost an insane amount of money. The same goes for here. What if price drops, but then they, instead of, sorry about that, instead of going up, they just continue going down. You would also use a stop loss here. Let's just see 46547. Go to modify, stop loss 46547. Okay, sorry about that. I think I made a mistake with the last digits. 46507, my mistake. Yeah. So if you can see in the bottom right corner, show that you have a potential loss of about 2,371 rands or 209 pips. If you move it up, the loss gets smaller and smaller. Take it down, the loss gets larger and larger. So I hope I kind of explained the difference between the different types of market orders. Buy stops and sell stops are for continuations, and then limit trades are for reversals. Now, let me show you what happens when you trade in a live market in terms of market execution. So let's just use this resistance example we did moments ago. We want to use the whole lot size explanation here. So I want to sell at this point at 1.48195. So that's where I want to sell. So this is where I want to sell. And now let's say I want to use a lot size of 0.20. Sorry about that. 0.20 is my lot size. And then how much do I want to risk? Basically, what you need to ask yourself is, how much capital am I willing to risk before the market lets me know I'm wrong? So if you sell here, but then the market keeps going up because it can, how much capital are you willing to lose? That's where risk management comes in. So let me just put this up here. The price level we want to sell at is 1.48195. How many pips from that would you be willing to lose? Let's just make an example of 200 pips. Let's see, 195 plus 200, around here, 395. So this is where you enter, this is your, in fact, let me just switch the two. I think it makes more sense that way. The blue line is where you want to sell, and then the red line is your stop loss. So from here to here, it's about 200 pips or 199. So if I multiply 0.20 by the spread, sorry, not the spread, the pips that I'm willing to lose before the market lets me know I'm wrong, gives me about, just get this here. So the 0.20 is my lot size, and then the 199 is the amount of pips I'm willing to lose. So the pips do not equal the amount you are going to lose or you're willing to risk. The amount you're willing to risk is 0.20 multiplied by 199, which gives you $39.8. So the distance from here to here, if I'm wrong, I would lose about $40 even. But say now, let me just use this level as an example. Say now price does come here. I sell successfully, they don't hit my stop loss, and then they fall all the way down here. What do we do then? Same concept, just take the highest number, subtract it by the lowest number. So in this case, it's 1.48195 minus 1.46690. So let me just type that in. This is to see potentially how much we would make if we were right. So let's see how many pips this is. It's about 1,500 pips, slightly more. Let me just type this in. It's about 1,500 pips. So if we multiply 0.20 by 1,505 pips, gives us about $301. So if price were to drop all the way from there to there, the reason the price level is there is because it's potential support. We outlined that in video 3. We would make about $301 with a risk of about 40. So it's a pretty good risk to reward ratio depending on your balance. You don't want to risk $40 on one trade if your balance is $100, because you might be wrong 3 times in a row, and then if that happens, your account is already blown. But we'll go further into risk management in June. I'm really excited about the June videos. I think you really want to like them. It's a total shift in how you view Forex. This was just a beginner course. You can think of it as a beginner course. In June, that's where the heavy thing starts. So I hope this video was informative. I hope you learned something of value. Please subscribe if you're new. Leave a like on the video. It's Mr. Billionaire 23 signing out.